All right. Good morning, everybody, and welcome to Coffee and Corporates. This is an event that we hold twice a year, and I'm so happy that we could see you here. Although I hope to see you in person very, very soon. Um, I wanted to tell you what we're going to do this morning. We're going to talk a little bit about the market and the market in New York City and tell you what really happened in the past 6 months. And then I'm going to invite a few of my partners and colleagues to talk to us on specific deals and what they see in the market. It's going to be my partner, Victor Sozio. It's going to be my partner, Mike Tortorici, our senior director, Sean Kelly, and our director in our capital services division, Matt Swerdlow. And before we start, I wanted to extend a special thank you to my partner, Ivan Petrovich, and to also Remy Mendel, who led the effort of putting this event together, the presentation, the panel, and communicating also with legal outreach, which we'll talk about in a second. Those of you who are not familiar with me, my name is Shimon Shkury. I'm the president of Ariel Property Advisors. Our company is a real estate investment services company here in New York City. We have three divisions: the investment sales division, where our brokers are focused on geographic area throughout the city; our capital services group, which provides debt and equity advisory and placement for our clients nationwide; and our investment research group that provides a tremendous amount of information throughout the city to our clients and to the industry. And much of the information that we have here is through that division. Our reports are out for the quarter and for the first 6 months of the year, and you're welcome to go on our website and download them. They should be available by now. Before we start the official presentation, I wanted to extend a warm welcome to James O'Neill. James is the executive director of legal outreach, which is a very special after-school program which Ariel Property Advisors have been supporting over the years. Also, a special thank you, which will come from James, to Aman, who is helping us, or legal outreach, to raise $350,000 or to win a prize for $350,000. James is going to tell you more about that prize, but also more about our real estate program that we've done in the past year. And hopefully you can get involved in many different ways with legal outreach. James, please take the stage and speak with us a little bit about the organization.
Happy to do so, Shimon. And thank you so much for that introduction. I'd like to thank you, of course, as well as all of your partners and all the staff at Ariel Property Advisors for your consistent support of legal outreach for over a decade. APA has made a difference, not just with monetary and financial contributions, but equally as important, by opening the eyes of our students to career opportunities within the real estate industry. And for that, we'll be forever grateful. Perennially, Ariel Property Advisors hosts a week-long summer internship for 4 of our students and has continued to do so even virtually over the past 2 summers. This has taken some adjustments, but the program has worked well and our kids have benefited from that. This year, however, APA went a step further, that is going beyond just internships, and in conjunction with Burden LLP, coordinated 9 professional exposure workshops, 1 per month from October through June, for 20 of our students who expressed an interest in learning more about career options in real estate. Workshop presenters included not only APA and Burden, but also Fisher Brothers, Signature Bank, and Camber Property Group. For anyone in attendance today who desires to join in on the fun during the coming year by conducting a 90-minute workshop that opens the eyes of our students to the work performed by your company, please reach out to me at joneil@legaloutreach.org. We will be glad to include you, and let me tell you that our students will appreciate gaining the insight from insiders within the industry itself. We know, of course, that not everyone can host a workshop or internships. However, there is one project in which everyone can participate that would be tremendously beneficial to legal outreach. We're fortunate that Aman McConnon, who regularly attends the Coffee and Cap Rates event and is a director at Greystone, is also a Chick-fil-A franchise owner in Queens. And as such, he was able to nominate Legal Outreach for a Chick-fil-A True Inspiration Award for the work we do trying to change the educational trajectory of students from underserved communities. Everyone who is in attendance and everyone at your companies can help us become a True Inspiration Award recipient by voting for us online in September when the portals open. More information about this will be forthcoming from Ariel Property Advisors in the near future. Thank you so much, Aman, for your support of our work at Legal Outreach. And thank you so much, Shimon, for allowing us to publicize this opportunity at today's event.
Thank you, James. This is fantastic. And for those of you who don't know James O'Neill, Google him. He had his life story at the Michael Stoller show, and you definitely want to hear it. It's super interesting and tells you what kind of values a person like James has that allows him to build, start, and lead legal outreach to the tremendous organization it is. So thank you for that. And with that, we're going to start with the presentation and talk a little bit more about New York City and what we've seen in the past 6 months. And right after that, we're going to go into the panel discussion with my partners and colleagues at Ariel Property Advisors. We sat here in January of 2021 looking at pictures from the last year, 2020, and these pictures weren't pretty. And one of the things we said then is that we feel the worst is really behind us. And that was the case. If you look at today, 6 months later, about 60% of New Yorkers are vaccinated. People are going out and eating in restaurants. People are going out to museums. They're sitting outside. More people are in the office. It's far from being perfect, but it's definitely a boost in the right direction. So when we look at numbers, the first numbers that come to mind are the numbers for volume of transactions and number of transactions. And as you can see from this chart, in fact, the first half of the year of 2021 was not that impressive when it comes to the number and volume of transactions. But you really have to look further and look quarter by quarter. And the second quarter tells a better story of what's happening. So these numbers are lagging indicators. And in addition to the second quarter that has been great, we can tell you that at Ariel Property Advisors, we have more than 50% higher contract signings this period of time compared to the year before. More than that, our colleagues outside of Ariel are experiencing the same. So chances are this year, 2021, the second half of the year is going to end stronger than what we're seeing here and be equivalent to 2022, if not even higher. These are the probabilities. So again, positive momentum. And that brings us also to the bounce back effect. What happened in the past 6 months is tremendous. The first thing that happened was unemployment rate dropped to about half of what it was in the height of COVID. We're still higher than the national average. Remember that tourism counted for about 90,000 jobs that were lost. Tourism and hospitality and events are just starting to come back. So we still have ways to go, but we did bounce back quickly and rapidly within a 6-month period. If you look at the mobility reports, you see that there was a 41% improvement since January alone in public transportation, people using public transportation, 28% higher in attendance in offices, and 42% higher when it comes to using retail or going through recreation centers, restaurants, etc. This is all in the past 6 months. again, we still have ways to go. We're still lower, about 40 to 45%, depending on which item, but about 40% compared to pre-COVID. But we had a robust bounce back over the past 6 months, and we believe it'll continue. Residential rental vacancy has come down as a result of this bounce back in the fundamentals. I mean, we're looking at less than 3.5% vacancy. There's still concessions. Rents are still lower than what they were. The next thing to improve is less concessions and higher rents. In fact, when we talk to investors today, to free market multifamily investors, the anticipation is for robust growth over the next 2 or 3 or 4 years. So we're definitely seeing that come back. Also on the vacancy rates, condominium sellouts have been good in the second quarter. In fact, the third highest condo sellouts in the past decade. So definitely pent up demand, higher pricing compared to the year before. For the luxury condominiums, let's say about $4 million, we've seen about 13% increase in value quarter over quarter on average. So even the condo market is doing better in the second quarter. So when we talk about pricing and drivers, I want to caveat it by saying there weren't too many transactions to choose from. So we really have to be very careful when we conclude, but we'll try to be as precise as possible. Well, let's start with development pricing. With land pricing in Manhattan below 96th Street, you see an increase in value to $557 per square foot. But then you look at 407 Park Avenue, which was definitely an outlier and sold for $950, which was a part of an assemblage. If you take that comparable away, you see that the numbers did not really change between 2020 and 2021. They're rather low. They're less than $500 a buildable foot. Our belief is that once developers get confidence in the condominium market again, specifically in Manhattan below 96th Street, these land values will be extremely attractive and in fact will start climbing up pretty quickly. We anticipate that happens within a year. So if you're looking for opportunity today, land in Manhattan is one of them. The rest of the boroughs have fared in a mixed way. And the reason is, in many cases in the boroughs, you're targeting, as a developer, a residential development. As you all know, the 421A or Affordable New York is up for a change or in the middle of 2022. And that really puts a challenge to develop residential rental. This unknown is something that Albany will have to resolve. And this is where we anticipate a little bit of a slowdown or a lot of a slowdown until there's more certainty in Albany between now and hopefully June of 2022. The multifamily market is interesting, and we're looking at 3 subcategories: the affordable market, the free market, and rent stabilized. Let's talk about what the pandemic did to each one of these and where the near-term performance is going to be. In terms of affordable housing for multifamily, the pandemic had a positive effect from an investor's perspective because of certainty of collections, because of certainty in taxes. In many cases, you have tax abatement, and because of specialized capital, either mission-driven capital or advantageous debt financing. The near-term performance is also good. In fact, we know, and we're going to talk about it during the panel, that we have a tremendous amount of contracts that are going to close by the end of the year. So from a transaction perspective, we will see positive changes in the very near term. The free market world was negatively impacted by COVID, and the reason was mostly people leaving the city and vacancy. As we saw from the previous chart, that is starting to improve, in fact, bounce back very quickly. The near-term performance is extremely positive for it, as I discussed before. Rent stabilized was not affected by the pandemic as much. I should caveat it by saying some collections were affected, but values were not affected by the pandemic. It was affected by HSTPA, the Housing Stability and Tenant Protection Act of 2019. The near-term performance, however, we believe is going to be positive. We started seeing pricing, or we started seeing more transactions going through, which creates more pricing clarity. And we believe that will force more transactions into the market. We also know that it's a very sensitive subclass to interest rate, and interest rates today are extremely accommodating. So let's talk about multifamily pricing. And when you look at multifamily pricing, one of the things to talk about is how many units were rent regulated versus free market. And as I mentioned before, these numbers don't tell a full story. So we can't just look at averages. We have to look building by building when we now analyze it, but it tells somewhat of a story. So in Manhattan below 96th Street, there was actually growth if you look at price per foot comparing 2021 to 2020. Only 23% of the units that traded were regulated compared to more of that last year. Northern Manhattan was exactly the opposite. 76% of the trades were rent regulated, and that's what forced pricing to go down. So again, it doesn't mean that Northern Manhattan went down in value. It just means that the mix of buildings that traded forced the average numbers to go down. Similar things happened in the Bronx, and Queens and Brooklyn were mixed. Our anticipation of capitalization rates and prices per foot in general, if you look separately at multifamily in each one of these subsections, is to further go up. Cap rates will probably compress further in the near future as demand increases for investments. So what moves the needle? What happened in the bigger transactions? The first interesting part of it is the growth in the number of transactions between the first to the second quarter. 11 sales above $100 million versus 2. But what was interesting is that office and retail actually did well if it was well located, like the building that SL Green sold on 6th Avenue and West 20th Street. We had Staples there and Microsoft as 2 tenants. We had more tenants there on the retail side, definitely stable tenants. And we had 80,000 square feet in the SL Green building that were renewed by a tech company. So stable location, good tenancy, good cash flow, selling for $1,435 a foot. Very similar scenario with the Broadway deal that sold for $1,700 a foot. But also the office market, the office leasing activity grew by about 14% in the second quarter compared to the first. And this is a chart that shows how many people or companies actually renewed leases like Blackstone or got new leases like the City of New York, Legal Aid Society, and Mount Sinai, all in the first and second quarters. So robust, much more robust leasing activity in New York City. The multifamily market on the affordable side did well in the Bronx, for example, with a $122 million deal that was sold to a nonprofit and will be preserving affordable there with AMI's area median incomes at lower than 80%. And we also had the other extreme, which is Stonehenge buying a building on 920 Park Avenue and 80th and Park, luxury apartment building, predominantly free market, and probably a major rehab and increase in rents over time and catering to the luxury market on the Upper East Side. So these two transactions just help us explain where New York City is going in both ways, affordable and free market, in a much stronger way compared to 6 months ago. So what should we watch for when we are talking about our watch list? The first thing, clearly something that we cannot ignore, is the Delta variant. We know what a pandemic means by now, so it's not going to be a black swan, but something to watch for. Our belief is that the bounce back we've experienced will continue. The Delta variant might slow it down, but we will see growth in the next 6 months. Local law 97, that's the emissions law, something that landlords are paying attention to now. CPACE is a financing tool that allows to put cheaper mezzanine, less expensive mezzanine on buildings to accommodate something like the local law 97. 1031s, something that the Biden administration has been talking about to stop. 1031 tax deferred exchange is the ability to take a building, to sell a building, move the proceeds into another building and defer capital gains. Really what it does is it keeps the investor in the same asset class, which is, I think, important. So hopefully that doesn't go through. But if it does go through, it's going to negatively affect real estate throughout the United States, not just in New York City. Inflation is a good thing for real estate in general. Clearly, there's caveats there. And the local politics, Eric Adams was the favorite when it comes to the mayor's, when it comes to the real estate industry. So from a real estate perspective, that is a positive. 421 expiration and J51 on the city level. The 421 expiration is something that I mentioned before, something that we're watching for and want to get a lot more clarity and a lot more certainty. It's important because without a tax abatement, it doesn't make an economic case for building a rental building anywhere. So it's important from our perspective, from the real estate perspective, for developers to really get clarity from Albany about what they intend to do so they can start buying land again and develop. Conclusion is that the second half of the year should be a lot more transactional. We believe that pricing and fundamentals are going to be better and stronger. And we're seeing this pretty much, as I described before, in every avenue of the real estate market and the general New York City market. That really concludes my presentation. And what I want to do now is I'm going to stop presenting and I'm going to jump into our panel discussion and ask my partners and colleagues to show themselves. And we are going to introduce them one by one and start the interesting part of Coffee and Cap Rates. Before I do so, I want to tell you that we have a chat room and you're welcome to start asking questions if you want to, and we'll try to answer them. If we don't answer them, we'll try to send you an email afterwards and with the answer. So I wanted to mention that. So thank you everybody for being here, and I'll start introducing each one of you. So the first one is my partner, Victor Sozio, who is leading many of our bigger transactions, and we'll talk about that in a second. My partner, Mike Tortorici, who is involved in many interesting transactions, and we'll talk about the sellers that he's in and talking about, as well as several nonprofits that he's working with. Our senior director, Sean Kelly, who is prolific in Brooklyn and specifically also in development sites, and we'll talk to him about that. And our director, Matt Swerdlow, director in our capital services group, who is going to tell us more about financing and about, hold on, let me see that sorry. And is going to talk to us more about capital, mortgages, and equity. Let's start with Vic. Vic, you have led several large transactions for the company in the past few months. And you've done also tremendous job in the affordable housing world. Tell us a little bit more about what you're seeing today in that world.
Sure. Good morning, Shimon, and good morning, everybody. I guess let's talk a little bit about multifamily. And I think if you look at the data, the multifamily data for the first half of the year, it starts to give you a picture of a city that's slowly coming out of a pandemic and still adjusting to the HSTPA legislation of 2019. You know, it's clear that the second quarter, you touched on it in the presentation, it's clear that the second quarter was a lot more active than the first or the other quarters in 2020. And it makes a lot of sense because rents have come back in a real way to pre-pandemic levels, in some cases and locations even exceeding pre-pandemic levels, which is surprising that it came back so quickly. The dollar volume for the second quarter on multifamily was about $1.25 billion, which is not quite where it was in a, let's quote unquote normal year, let's say, or normal quarter in the past, but it's getting there. And to put that in perspective, it tended to average around $2 to $3 billion a quarter in a more normal year, let's say between 2000 or normal quarter in 2016 to 2018. 2015 was, $5 billion a quarter essentially at the peak. What's interesting is that, and you touched on this, I know that the average cap rates have ticked up overall, but if you really see what's out there, quality assets haven't dropped off a cliff, much, right? Quality assets in Manhattan still trading around the 4 cap. Quality assets in Bronx, most parts of Brooklyn and Queens still tend to go between 5 and a 6 cap. So I think that that is a little bit skewed by a smaller sample size, and you touched on that earlier. Within the multifamily sector, the market for affordable housing has exploded, right? And is performing above and beyond expectations at this point. And part of what's fueling that, again, you touched on this in the presentation, is that when you have an opportunity that is large enough that can attract institutional equity, and there's just a lot of capital for it, right? And this is institutional equity that is essentially willing to accept returns between 10 to 12% if it meets their impact investment needs, their mission-driven capital, ESG capital, right? And at CRA, if it's a CRA eligible location, that goes a long way as well. There's CRA and PR needs that it serves as well. And what you're seeing is that the operators there are incentivized by the large fees that are associated with these transactions, but also the fact that they're serving a dire societal need, right, and providing quality and sustainable, affordable housing for families and individuals, and in many cases, sinking a lot of rehab dollars into these projects. So it's a really interesting market. It's never been deeper or more efficient than it is today, that market, right? And just to give a few fresh data points that support what we're talking about, actually today we're closing on a project in Central Harlem, an affordable housing project with a capital A, and I believe it's around a 4 cap, a project-based Section 8 property. And within the past 30 to 45 days, we went into contract on a few deals in the Bronx. One is around 500 unit complex, which was between a 4 and a 5 cap. And another one was a single elevator building above 300 units, which was also between a 4 and a 5 cap. And again, these are assets, affordable housing assets with a capital A. So it speaks to what you were talking about in the presentation.
Yeah, and Vic, I think one of the things you mentioned, which were interesting, is the quality of assets, not just going back from the affordable, just generally speaking about the multifamily world. And there was a question from the audience about the major leases, renewals, and so on. Our tenants are renegotiating at lower rates and terms. And one of the things I'll say to that very quickly on the office market is it's also a question of quality. I think that the office market today is an office market of two different worlds. You have the One Vanderbilt, and you have the Hudson Yards, and you have the World Trade, that are brand new buildings that are going to receive great or receiving great activity from tenants, and you don't see many leases negotiated or renegotiated there. And in fact, the rents are still high there. Whereas in classes B and C and midtown buildings that are older and so on, you do see that. You do see the renegotiation of leases and so on. So I do think that quality is important in the city in pretty much every asset class. You see it also in retail. So I just wanted to answer the question here with the audience. And I wanted to jump into Matt, just to build on what Vic was saying, and ask a little bit specifically about affordable financing. If you can give us 2 or 3 anecdotes on how the world view that today. And Matt, if you have a second for that.
Yeah. So thanks, Shimon. The really interesting part about what Vic said is Vic, I like how you put it. It's a capital A affordable housing project, right? Typically, if you were an affordable housing borrower, your outlet was Fannie Mae and Freddie Mac, right? Very good lenders. They do a tremendous amount of business, have very effective rates. But what we've seen over the last 18 to 24 months is a lot of banks in New York City, balance sheet lenders, come into the game and start to not only get aggressive on capital A affordable housing projects, but develop a capacity to lend on them. It's not as easy as just lending on a rent stabilized multifamily building. A lot of times there are state and city subsidies that are tied to the buildings, and your lender needs to know how to digest that information, how to really effectively close, and then sometimes subordinate that loan behind theirs, right? That takes a certain specialty that maybe 2 years ago, a lot of banks just didn't really have a need to do, right? But now as affordable housing has become in vogue, it's become something that the lenders need to catch up on and get up to speed to really continue to maintain their level of market share in New York City lending.
Yes, thank you. And you know, we're going to talk to you in a minute about this is conventional lending, and we're going to talk to you more about bridge lending as well in a few minutes. But what other question we have here from the audience is about development or small and new construction developers in free market condos and apartment spaces outside of Manhattan. And that brings me to Sean and talk more specifically about Brooklyn, because I know that Sean dealt recently with some development sites that were sold and can talk to it in a pretty insightful way. Why would someone buy, lend today, and how do they look at developing condos in Brooklyn, for example? Sean? Sean, unmute yourself if you're there.
Sorry, thanks, Shimon. The Brooklyn development market stayed pretty strong, and specifically in locations where there's not a lot of land, there's not a lot of supply, and the market has really performed well historically. So I think indicative of that was the first transaction we completed this year, which was the sale of 102, 106 North First Street. Terrific location, close to the waterfront in Williamsburg, again, where they're not making any land. We negotiated this deal sort of height of COVID, beginning at the end of 2020, and we achieved a pretty full number at $400 a buildable foot. And then to piggyback on that, even the smaller transactions, we're seeing a lot of demand in the Fort Greene, Clinton Hill, Park Slope, Brooklyn Heights market, where the product is going to be smaller condo buildings, 5 to 10 units. We sold a building in Brooklyn Heights, just off of Atlantic Avenue, probably 100-year-old building, really good bones, exposed brick, high ceilings, wide wood plank floors, and that will likely be repositioned into a condominium or a small boutique high-end building. And then, just to speak about the supply, another market that we are in contract on, and this is a very ethnic market where there's just not a lot of opportunity for development, is Sunset Park, and specifically the Chinese community in Sunset Park. So we're in contract there on a 50,000 foot project as well. And I'd say despite what
it's good.
Sure. Despite the pause in the market from, caused by COVID, we've really seen developers come back strong. And I think that's indicative of just the fundamentals of the Brooklyn market.
Yeah, and I think that you bring up some good points. When it's condominiums, you usually can pay more for the land. That helps the Brooklyn market. I know that Vic is handling a few deals outside of Brooklyn. I know I can think about, and outside of the city, actually, at least one of them outside of the city. And I can think about 2 or 3 transactions or deals that are currently in the pipeline. Vic, you wanna chime in on these developments?
Sure. For the most part, these are larger developments that, as it relates to the ones that are in the city, I think you touched on it earlier. It's a lot of the discussions now are if you can thread the needle in a way to vest for the current affordable New York framework before the sunset in June of 2022. So we're in a lot of active negotiations and a lot of pragmatic ideas that are being presented in order to do that, and I think there's a window now and a little bit of lead time that you can potentially do that if everything goes well. If not, to your point, it needs to be a condo developer. And the positive on that front is that I'm seeing a little bit more depth to that market than I've seen in the past few years. And truly, I think, and you touched on this also, right? If you're a condo developer and you have the equity for that, it's a great opportunity for you to go out there and secure a development site where we've seen some softening in values, and there's going to be a period of paralysis, from the rental development side. So they might be able to take advantage of it, again, if you have that equity that's subscribed. Outside of the city, I think if it's a location, a suburban location that has the right infrastructure, like Metro North or Long Island Railroad, I think there's a lot of good things about it. I think it tends to revolve around the same ingredients, right? Is there a pilot that's available in that municipality? What kind of true rents can you underwrite to? What is the terrain like? What's it going to be like to get entitled? But, you know, we're seeing a lot of appetite for that. And it's interesting, a lot of it is from traditionally city-based developers that have expanded their horizon and are looking in these suburban locations.
Yes, and you know, it's interesting because many of them we know and many of them we've dealt with. And I wonder, Mike, maybe you can chime in here, but I wonder if there are any new sellers that are coming into the market or clients that are selling, why our clients are selling in this lower transaction volume environment. Maybe you can chime in on this side of the market, Mike. I don't know if
Sure. So I think a lot of what we're seeing is, you know, many of it's demographic based. Regardless of the market right now, we're going to be the next decade seeing baby boomers retire, and with that becomes either estate planning that I think is driving a lot of transactions. It's family offices that are figuring out their next move, and if the next generation doesn't want to continue operating the types of buildings or the types of businesses that they've traditionally done, and they want to free up what in many cases is a lot of equity and put it towards other locations or other business plans. That's something that, regardless of the pricing environment, if a family office has a lot of equity, a nonprofit has a lot of equity in a property, they're thinking through right now how they can free that up and get it to work. So I think that's something that is going to continue to be a driver for sales, regardless of the environment. We're seeing that with nonprofits. With religious organizations specifically, many times they control vast tracts of land. We're working on a ground lease right now in the Bronx at 2450 Westchester Avenue. And the types of interested parties that are interested in it, you know, they're looking to bring new life to an area that hasn't seen, you know, a whole lot of development, in this case, in several hundred years. And the programs that are approaching it, sometimes it's developers partnering up with nonprofits or educational institutions. It results in unique things that could be coming into a particular area. Another point actually about that is the owner-user market right now makes this environment very difficult to paint properties in a broad brush. And what I mean by that is, you know, you look at the Bronx transactions that are taking place. And you look at $80+ a buildable square foot. A lot of that right now is driven by charter schools that are opening up big, you know, new facilities, and in some cases outbidding traditional mixed income developers. Well capitalized. I imagine that some of the infrastructure spending that's going to be going on right now with the Biden administration may be feeding into that, or other, you know, mission-driven programs. You know, there has been a very strong owner-user market in development. We've seen it in properties that we've sold and seen transact in Manhattan. Businesses, in some cases, paying over $1,000 a foot for existing buildings in Manhattan. A property that we sold on 109 East 9th Street had a very strong retail location, even though it had SRO tenants above. The owner-users were outbidding the investors by 10, 15%. And there were several of them. So there's a lot of things that are driving this market right now. And my hope is that the economic strength that we're seeing nationwide continues to propel things around here forward.
Yes, and you know, it sounds from you that capital is driving a lot of these things, be it debt or equity. And I know that Matt has been working with a few clients and doing some interesting deals in Manhattan, specifically on the bridge side. Maybe Matt, you can share it with us. The demand in Manhattan is strong for bridge lenders, et cetera, and just maybe chime in and tell us a little bit about it.
Sure. Yeah. So the bridge space is a very interesting space. It's very nimble, very flexible. A lot of different types of capital are being poured into the senior debt bridge financing space. We recently just closed a $46 million transaction in Manhattan, in different neighborhoods: West Village, Chelsea, Greenwich Village, Soho, where The sponsor required bridge financing, never really took it before. You typically just recycled their bank debt every 5 years. The pandemic had reduced their occupancy levels to a point where they could not service their maturing bank debt, and were really placed in a position where the obvious outcome was to sell. They didn't want to do that. What left are you to do? We engaged the bridge lenders in New York City pretty aggressively to create a bidding pool for this assignment. And we ended up closing at the end of June on some very aggressive terms that even, quite frankly, surprised me and my partner when we were working on this. The level of bidding was extremely aggressive. But the flexibility, the nimbleness, it has value. Many borrowers who have never taken bridge debt before might be surprised as to what that can really bring you and bring your business plans. There's certain things that bridge lenders can do, like very quick executions. Many of them don't do appraisals. Many of them are lighter on due diligence requirements. Many of them offer non-recourse as a standard guarantee, as opposed to banks who are offering who require full recourse. So it's really an environment in financing where I would encourage many people to explore. You might get surprised by what you find.
Yeah, and I know you mentioned capital here, and I know Mike before mentioned the government spending with regards to the infrastructure, but the government also, and this is something we talked about during the presentation, is also considering taking away the 1031 tax deferred exchange, for example, and abolishing capital gains and so on and so forth. And I know that we are sensitive to that, and our clients are sensitive to that, because if our client sells a building and they need to do a 1031 today and midstream it's gone, what are they going to do? And so I know Vic had a few nuanced deals recently relating to that, which I thought was super interesting. Vic, you want to tell us a little bit more about it?
Yeah, sure. You're right. It's worked its way into contract negotiations, and rightly so, right? It could be a pretty significant impact if a seller transacts and is not able to do a 1031 replacement that they have typically done. So in about 2 or 3 contract negotiations in the past few months, we've actually had to negotiate what equates to a lever for the seller to bail out of that contract if that legislation actually goes through, right? And we've had multiple discussions with tax consultants, even as part of these transactions, to get a sense of what it might look like. And the general thought is that if the transaction happens in 2021, you're probably going to be good. Even if that legislation goes through, right, you'll probably be good because it'll start in 2022. There's also another school of thought that it could be grandfathered for contracts that are in contract heading into 2022 when that legislation could be in effect. So we've worked timeframes into closings where, if it doesn't happen by the end of the year, they can get out. If 1031 doesn't go away, then that extension option still exists for the buyer. A lot of times what I think is a reasonable request from the buyer's perspective, because again, a lot of them are receptive to this because they understand how big of an impact it can be for a seller. Typically we work in some sort of breakup fee into that contract structure, so that if the seller does bail out because of this unfortunate legislation, that they would be reimbursed for a certain amount, typically tying into the cost spent to date, maybe a little bit more. But that is something that is starting to emerge as a more kind of a common contract structure in light of this proposed legislation.
Yeah, and I think contract structures are super interesting today, because there are some sellers out there that have no leverage, want to monetize their asset. They have, let's say, a building that is vacant or land that's vacant, and they're not willing to meet the market. They believe that in the future, prices will go higher. So one of the things we started working on, Vic, you and I, and I know that Sean and I are working on, and maybe Sean can comment on that, are structures that are different than just a pure sale. So, for example, a ground lease or a joint venture where the current owner is willing to stay in the deal in a big way. Sean, is that something you can chime in on?
Sure. And I think, funny enough, there's probably a couple of drivers to this, one of which is the exchange issue, right? Where if you're doing a joint venture and you have a developer buy in for 50% and you leave the other 50% in, you're only going to have to pay your gains on the half that you're selling. And then the other big ticket item that's on the calendar is the expiration of the 421A. So we've had some clients who own terrific real estate who may not be experienced in the residential development world, and maybe they have experience in another sector of the market, whether it be office, community facility, or retail, where they can execute a business, find the right partner with the right track record who has a background in executing these type of projects. And we're actually working on a couple of those now. And I think you're going to see more of that. And I think you're going to see the development transactional volume increase in the second half as more people look to get ready and get in the ground for the 421A.
Yes. And the 421A is definitely a major issue that will push many landowners to act, whether they are going to prepare it now for the to be ready to the new 421A, or to try to capture what exists today. I think it's just that uncertainty is not super healthy for the development market. And all of us remembering too, I think it was about 2015 or 16, we had a period of time that the market just froze before politicians could agree on what's happening.
And to that point, I mean, I think what
yes,
I think what politicians don't realize is when they freeze up that 421A, Manhattan continues on. Manhattan development largely goes to condo, regardless. The pricing, it's very difficult for things to work out pricing wise. But in the boroughs, that's where it really froze up. I remember especially freezing up on several Bronx transactions we had and some that we had in Queens. I think Northwest Brooklyn to some extent will continue to go on because that's also very much a condo market that's got a very strong demand there. But if they don't create the clarity that's needed on revising 421A affordable New York, it's just going to slow down the market, going to slow down supply, and going to work against affordability goals.
So we don't have much time right now, but we're stating that we're getting out of COVID. And I was wondering, at the beginning of COVID, we started seeing, from a financing perspective, we started seeing some COVID reserves. I wonder if they're still there. How do they change? And what do we do now that's different than the beginning of the pandemic in order to finance and work with lenders?
Yeah, so COVID reserves was definitely a structure that was kind of put into place really as, a way for lenders to keep doing deals and earning revenue right as the pandemic hit, and really no one knew where rents, values, or anything was going to go. And it has stayed to today. But fortunately, in the spring and early summer, we saw Fannie Mae and Freddie Mac reduce or remove their COVID reserve requirements, which was a big win for borrowers. Those were some of the more strict COVID reserves, specifically to the amount that they want reserved, what you can do with that reserve and how you get it released, what hurdles you have to hit. On the bank side, we've definitely seen the reserves get lessened. Typically, if a bank wanted 9 or 12 months of principal, interest, or taxes reserved, now they're down to 3 or 6 months. And then in certain cases, we've been able to negotiate for the reserves to be used actively. So instead of the amount being reserved just to be held static, like in Freddie Mac's case previously, a borrower was able to use their reserve to prepay essentially principal, interest, and taxes, and you would be able to recuperate that amount through your cash flow because you're not double paying it. So that was really a way for these transactions that needed to happen for borrowers to really get comfortable with a structure that many will tell you, I've never done a COVID reserve, before. Well, this is a way we can make it a little bit more easy to stomach. And we've seen that really it's been really successful for us lately to arrange reserves like that. But hopefully in the near future, as Delta continues to spread, we hope that the level of vaccination in New York City increases, and lenders in New York City will continue to pull back those COVID reserves.
Great. I think we're almost running out of time, so I wanted to extend one last minute for each one of you to say what you think the market is going to yield in the next 6 months or so, and we'll take it from there. Who wants to start?
I'll jump in. I think we're going to see a lot more transactions in the smaller multifamily market. The buildings are free market or mostly free market, as we're seeing institutional capital partnering with local operators. And I expect to see development transactional volume increase as people are trying to get in the ground for the 421A tax abatement.
Thank you.
I think we're going to see some interesting improvement in pricing for multifamily throughout the city too, as the floor is kind of set in, I think, on rents, vacancy is dropping. And right now the cap rates that you can see in Manhattan are the highest they've been, at least as long as I've been doing this. I think as long as all of us have been doing this in many cases. And, you know, the dynamic where New York City cap rates are higher than cap rates elsewhere around the country will drive capital here and ultimately bring them down. So I think we're going to see some positive improvement with fundamentals stabilizing and people coming back to the city.
Yeah, I'll echo what Sean and Mike said. I agree with everything that they said. I think the contract activity that you mentioned earlier, Shimon, will show up in the data in the second half of the year. And you know, to Mike's point, I think we'll see some improvement on pricing. Look, in the first half of the year for multifamily, there was only what 5,000 to 6,000 units that have traded throughout the city. I think that's going to grow pretty exponentially in the second half of the year, if I had to predict it.
I agree, Vic. I mean, if you look at your inventory alone, I mean, we're talking about thousands of units that are in contract, and I'm sure that others outside of Ariel have them as well. So I agree with you wholeheartedly. Matt?
Yeah, I think financing was really one of the shining lights in the last year. You know, many people will say financing got, you know, worse with COVID reserves, right? But rates are still historically low. Sometimes even lower than where they were at the previous low point, comparing where your index might be at any time that you're procuring financing. And a lot of borrowers should realize that even though there might be a COVID reserve, the worst case scenario is if there's no capital available at all. There's many banks lending right now. There's many, the agencies are actively lending. The CMBS lenders are actively lending, life cos, bridge lenders. There's a tremendous amount of debt capital that needs to get placed. And I think going forward, that will continue to be true. And really the ones that win are borrowers and those that are well capitalized to be engaging in acquisitions at this time. They will be pleasantly surprised with what kind of financing we can procure them these days.
Excellent. So with this very, very optimistic view of our world, I want to conclude. I want to thank everybody for participating and everybody for watching. I want to remind everybody that Legal Outreach is an organization that is worth you researching, and would really appreciate if you could vote for them, and we'll send the emails about the voting procedure in September. That'll help tremendously, and that's a no-brainer. It's a very easy thing to do. And thank you, everybody, and have a great continued summer.
Thanks, Shimon.